the last class we saw the problems on the valuation of goodwill and the super profit method. Okay, and I hope all of you understand that the problems on the purchase of super profit method or the annuity method. Okay, so in the last class we saw the problem on the purchase super profit methods as well as the annuity method of valuation of super profit. Okay, so it is the gap, it means what's in this annuity method, it is the time gap between the actual payment of a goodwill. Okay, so amount the actual earning of the super profit in the future, that's the ascertain. Okay, so now what's the formula for the ascertain of the goodwill? Super profit into annuity value. Okay, so the super profit we have to ascertain. Okay, so like this we have to solve the problem on this. Okay, so now in this session we will see the capitalization of super profit method. Okay, what's the capitalization of super profit method? So now see what the mean is. Under this method, the value of the goodwill of a business is ascertained by capitalizing the amount of super profit at the normal rate of return. This method is tries to find out the amount of capital needed for earning super profits. Okay, so this is also very important methods to ascertain the goodwill. Okay, and so this writes ascertaining, it's ascertaining for the super profit at the normal rate of return, for the capitalizing the amount of super profit at the normal rate of return. Okay, so what's the formula to ascertain the goodwill under this capitalization of super profit method? So goodwill is equal to super profit into 100 divided by what? NRR. NRR means what? Normal rate of return. Okay, super profit into 100 divided by normal rate of return. Okay, so now with the help of the problems we will understand how to ascertain the goodwill under the capitalization of super profit method. Okay, so now see the problem. From the following information, calculate the value of goodwill of the business by capitalization of super profit method. Okay, capitalization of super profit method. Okay, so now the information is given. The profits earned during the past 4 years. Okay, the profit is given for the 4 years. For 2012 it's a 42,000, for 2013 it's 84,000, for 2014 it's a 63,000, for 2015 it's a 91,000. Okay, so the year wise the profit is given for the 4 years. Now second one, the firm has the average capital employed in the business rupees 4,20,000. Okay, this is the average capital employed. Okay, so next, the pure rate of return on capital investment is 8% per annum and risk premium expected is a 2%. Okay, so this is the normal rate of return. So this normal rate, total normal rate is what's 8 plus 2% is the 10% is what's the normal rate of a return. Okay, so next, the landlord has decided to increase the rent of the shop building by rupees 7,000 per annum. Okay, so the landlord has increased the what's the rate of that shop. Okay, so rupees 7,000 per annum. It means what's from this average profit we have to minus this. Okay, so we have to ascertain what's the goodwill. Okay, we have to ascertain the goodwill, and you know what's the formula of the goodwill. What's the formula? Super profit into 100 divided by NRR, normal rate of return. Okay, so for the ascertaining of this goodwill we require what we should know the super profit. And what's the formula of the super profit? Adjusted average profit minus normal profit. Okay, so for this purpose we should know the average profit as well as the normal profit. Okay, so if you want to know the normal profit, then what's the formula? Average capital employed into normal rate of return divided by 100, you will get the normal profit. Okay, so the adjusted average profit. So first of all we have to ascertain the average profit. Okay, so one by one just see. So this is the information. With the help of this information we have to solve the goodwill. Okay, so now see, first of all see the average profit. What's the formula of the average profit? Profit of the past years divided by number of years. Okay, so profits of the past years means what? Take it the profit of these 4 years. Okay, so the total of this past year 4 is what? 2,80,000. Number of years is 4. Okay, so rupees 70,000. Okay, so next, adjusted average profit. It means what? Whatever the average profit is 70,000. From this 70,000 we have to minus the rate of building 7,000. Okay, so this 70,000 minus 7,000, the remaining is what? Rupees 63,000. It's the average adjusted profit. Okay, so now it is help for the normal calculation of the normal profit. And what's the formula for the normal profit? Average capital employed into normal rate of return divided by 100. Okay, what's the formula? Average capital employed into normal rate of return divided by 100. Okay, and so what's the average capital employed? So in the problem the given was 4,20,000. So this 4,20,000 into 10 normal rate of return. So this 8 plus 2 is a 10%. Okay, divided by 100. Okay, so the answer will be the 42,000. Okay, so the normal rate profit is also 42,000. Okay, so now the calculation of the super profit. So what's the formula? Average adjusted average profit minus normal profit. And what's the average adjusted profit is 63,000 minus normal profit is 42,000. So rupees 21,000 is what's the super profit. Okay, so now put into the formula of the goodwill. So goodwill is equal to super profit into 100 divided by normal rate of return. Okay, so this 21,000 into 100 divided by 10. The answer is what? 2,10,000 is the goodwill value of the goodwill. Okay, so like this you have to ascertain under the what's the which method? Capitalization of super profit method. Okay, so this is also very important to find out the amount of capital needed for earning super profit. Okay, it's needed for the earning super profit. Okay, so just keep in mind the formula for the for the ascertain of the goodwill. Okay, super profit into 100 divided by normal rate of a return. Okay, so I hope you will understand. Okay, thank you.